biggest mistake I see made, and this happens all the time to probably newer investors, is they miss out that property taxes will actually be going up. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always, I got the one, the only, Matt Jones. Matt, how you doing today?
I'm doing fantastic. How are you doing?
I am doing awesome, man. Awesome as always. Anything new in your world, Matt?
Not much. Just kind of same old, going through the numbers with underwriting deals. I mean, there still seems to be a big divide between what people are trying to sell their properties at and what I can conservatively buy, but still underwriting away.
Yeah, there's a big disconnect. I will agree with that, man. But some buyers are just being super aggressive. I don't know. There's two ways of thinking about it. We can talk about that. That'd be a whole episode. There's obviously this will continue. Interest rates are going to stay low. Cap rates are going to stay compressed. Inflation's going to hit. And so where else would you want to have your money? Real estate's the place to be. And having mortgages, right? If you have a mortgage and inflation happens, that mortgage doesn't go up. Technically, really, it goes down, right? Because now your same $100,000 that you owe, you've got inflation that's happened. So now you've got $200,000 versus $100,000 to pay for it. So, if runaway inflation happens, real estate, mortgages, that's the place to be. Of course, things don't continue to go to the sky. They, at one point in time, they're eventually going to go down. And when things are over exuberant, you have to wonder, is this the end? Is it going to continue with the exuberance, or is this kind of where it's ending? So, look for opportunities where maybe others aren't seeing the opportunities that can be in multifamily and specific niches in multifamily. That's what I'm looking at with large value adds. At times, more redevelopment plays. Also looking at different things we can do to these properties that other people maybe aren't looking at. Other income ideas, other expense reduction. And then also I'm looking at obviously different industries. Looking where people aren't looking, I think is really key in this time to continue to try to grow your business.
Yep. Great advice. Along with this disconnect, I mean, there's lots of other people who are willing to overpay for properties in my mind, but I'm not going to change my underwriting model just to get a deal done. Yeah,
I agree. A lot of people are willing to overpay. I just saw a deal that came across my desk. I don't know how I got on their list, but I can't believe they're doing the deal. They're buying. In no way, shape, or form does it even come close to working for what I would need and what I feel like my investors would want. But hey, they're doing it. I would expect to lose some good amount of money, and their investors will lose a good amount of money. But their money's in real estate. So if the market continues to go up, I guess everybody will be okay.
Mm-hmm. And that's hard to predict. I mean, you just don't know.
Yeah. I mean, look, if that deal that they close, they experience, 7%, 10% annualized growth in rents and in, in everything, then they'll be good. Then they'll be fine. Their exit cap rate, they're showing a compressed exit cap rate from where it's at today. So like the market right now for that class of property selling at about a 4 3/4. And they're saying that they're going to exit in 5 years. I think it was at a 4.25. So they're showing that the cap rates are going to continue to compress. Could that happen? Sure, it could. So just being, people are doing things like that, being very aggressive. You got to decide, is that the way you want to underwrite or is it not?
Exactly. That sounds like they're leaving no room for error. I mean, if anything goes wrong, then they lose money.
Well, if everything goes normal, they lose money. So as long as it goes normal, they won't be okay. it has to go up drastically for them to be okay. So it is what it is. I mean, it's crazy that to me, but people are investing in their deals and they're excited about their deals. And so, it's working for them, at least right now.
Yeah, yeah. I mean, I forget the saying that your rising tide, raises all ships. When things
Yep.
are good, everybody makes money, but the true, entrepreneurs are the ones who can make money regardless of what's going on in the climate.
Yep. Yep. Um, that kind of brings us into today's topic. Why don't you introduce today's topic?
Yeah, today we're continuing the multifamily series, and we'll be talking about underwriting. It's a key part of your investment strategy. If you're not underwriting appropriately, you're setting yourself up for a potential disaster.
Yeah, it's tough to talk about underwriting when we're on a podcast because I can't, really show people the numbers. So that's going to be a little more difficult, but I'll try to navigate through it, and we'll do the best we can. So I think the very first thing when you're underwriting, you've got to be looking at the market that you're in. You've got to look at either choosing a market or if you're in your own market, what's going on within your own market, and then what's going on within that sub market that you're going to be, investing in. So for me, I look for a few key things when I'm looking at the market / sub market. I want to make sure my income level is at 35,000 or above. I feel like that allows my residents to be able to actually afford rent. I feel like it's below that, then it's okay strategy, but your niche, your strategy should be affordable housing, and it should be subsidized affordable housing if you're going to go with the lower income levels. You want to see population growth within 5 miles, population growth within a mile. You want to see that the future is holding that population growth, or at least expected to be continuing with the population growth. Along with that, you want to see the job growth happening too, and income growth. So not only job growth, but also income growth. Is that actually happening within the market? Again, I want to see job growth within about 5 miles or less. I want to see ease of transportation too within the population and job area of the submarket I'm looking in. The other thing that I really look for is what kind of government support is going on. What's the economic plan, development plan? What's the government doing? What kind of nonprofits or programs are kind of around, to help that out. The other thing is I want to see what rent affordability is and then cost of living is. I want to make sure that we've got good rent affordability and cost of living. And I want to make sure that we've got a market that has a strong rental, I guess, projections. We want to see rent increasing. We want to see, it doesn't need to be drastically increasing. I actually don't love drastically increasing markets. But I also want to see good, tight vacancy rates, and I want to see that trend line going the right way. And I also don't want to see a ton of new construction with negative absorption or with slow absorption of those. So those are some of the things I really look for within a market and a sub market as I'm looking at that. And there's a lot of data out there, free data that you can find. You can of course pay for it, but there's a lot of free data, and a lot of that's on the broker's website. So, Marcus and Millichap, Colliers and Cushman and Wakefield, JLL, CBRE, they all have great information. ARA Newmark. So,
Yeah, and some of it you can just ask the real estate brokers for directly. If you have a specific asset class that you're wanting, and B versus A versus C or D, you can ask them like, what's the average cap rate and what's the average per door that's properties are selling at right now. And so those are some key information that you're going to need for your underwriting model. There's so many factors that go into underwriting. If you're new, I don't recommend that you try to create your own underwriting model from scratch. It's better to you either buy one, or some people you can get it for free from as well. And then you could just plug and play all the different data points into to figure out if a property is going to be good for you or not.
Yeah, and I agree with that. I think you need to make sure whatever you have is a version that you can actually edit to make it your own, because you might find that some things are not as important that are on there, or might find that some things are even more important that you really don't like how certain things are set up. So make sure you have a version you can actually edit. But I agree, it's nice to have something that's already been created, at least a good template to start from. Because man, I actually created my own from scratch, and it took me years of development, and I'm still developing it. I'm still constantly adding more to it and changing things. But oh my gosh, if I would have known that I could have bought one of those or got them from somebody else, that probably would have been the way for me to go because it took me a long time to develop mine. Again, mine started in development in 2008, and I'm still changing it as we speak. So, when we're looking at underwriting, we got to have some basics, in my opinion. So, what makes a property strong? What makes a property work? Okay. So I've got to have cash flow. Now, it doesn't necessarily have to be cash flowing today, but it has to, when we underwrite it, it has to have cash flow. Now if I'm doing my large value adds where I'm putting a lot of money into it, it's probably not going to cash flow or cash flow well to start, but where are the numbers looking as we get down the road? And do we have solid, ample cash flow? Okay. The next thing, and this is big, and this is something I think a lot of people miss out on, is we have to have ample cash reserves. So I think a lot of people they're raising money, the deal's tight, they're trying to make this thing work, and what are they going to do? They're going to trim some of the fat, and one of the things they trim is the cash reserves that are sitting there. Don't skimp on cash reserves. I want to make sure I have at least 9 months worth of principal and interest payments, okay, set aside. To start when I start this property, I want to make sure that my renovation budget is nice and fat and juicy, and I have a nice reserve for my renovation. Now, it depends on how big your renovation is, but if you're spending, let's call it 5 to 7,000 per unit, you should have at least a 10% kind of reserve fund on top of that. Now, that's on top of the 9 months worth of principal and interest. I'm doing larger renovations. A lot of times we have 15% for ours, just in case. These are just in cases. And oftentimes those just in cases actually do come up. And so we tap into that. So we want to make sure we have ample cash reserves. That's huge. The last thing I want to do is get caught in that. What happens if a pandemic hits? Okay. I know likely won't ever happen, but what happens if a pandemic hits and we need to tap into our reserves? Okay. Solid debt financing. What kind of debt financing do you have? You want to make sure you have the right debt financing for the right strategy. So I think that's really important. And then, again, being conservative, and conservative is thrown around a lot. Everybody says they're conservative. I'm sure the person I was talking about earlier says they're being conservative. So everybody talks about being conservative, but are you truly, check yourself? Are you truly being conservative? Do you have a truly conservative renovation budget? Do you get your renovation budget from a contractor and then add onto that? Or did you kind of make it up on your own, and maybe your property manager and you kind of work through it, and you're being really tight on your numbers just to try to squeeze this deal across the table? So, and then same thing with expenses. Look, operational expenses on a property typically cost more than what you expect them to. So are you being actually conservative with those assumptions? Are we saying that, we can really trim the fat that this property owner has? I mean, sometimes that's true, right? But oftentimes there's a reason their expenses are at where they're at. And so we want to be really watching what our expense assumptions are, and of course our income assumptions too.
Yeah, I think you really have to be planning ahead. Especially with like capex. I see some people using cash flow in their underwriting to be able to pay for their capex, and I think
dangerous.
it's a serious faux pas. I mean, you're setting yourself up for disaster. if you're not planning ahead, if you're not, conservatively underwriting, expecting like, hey, things aren't going to go perfect. So when they don't go perfect, I'm ready for it. If you're fail to plan, you're planning to fail in your real estate.
Yeah, exactly. Exactly. Good. I mean, great point. People, you've, if you're, I mean, if you're planning on paying for reserve for anything out of your cash flow, it's just a dangerous place to be in because, yeah, I mean, it's just a dangerous place to be. So let's talk about when we actually get these numbers, when we get a property brought to us and we're starting to look at that. Um, first of all, be skeptical on the numbers. It's kind of that trust but verify, right? So we want to look at these numbers and we want to really dig in. Especially when we're looking at broker pro formas. I mean, that's the big thing. A lot of these brokers have these fancy OMs and they're great. They give a lot of great information, but you got to be careful with these brokers' numbers because they're trying to sell the property, quite frankly. And that's their job. Their job is to sell the property. Their job is not to give you the most conservative underwriting numbers out there. No, they're trying to give you semi-realistic numbers. Some brokers are very realistic. Other brokers are kind of pie in the sky, but they're trying to give you some numbers, but they're also looking at it with rose-colored glasses. And so be skeptical of the seller's numbers, be skeptical of the broker's assumptions, and trust but verify. The biggest mistake I see made, and this happens all the time to probably newer investors, is they miss out that property taxes will actually be going up, right? So they got this broker pro forma, and the broker says that property taxes are $220,000 this year, and they'll be $220,000 next year. Yet the assessed value of the property is let's call it $5 million, and you're buying it for $9 million. Well, guess what? Your property taxes are going to go up. Promise you. So just trust but verify, dig in, make sure that what you're looking at is actually accurate.
Yep. And having the understanding of the local market is really helpful. So you can have a better understanding of what renovation costs are actually going to be and what property management costs are actually going to be. So that even though they might, the broker might be looking at things through rose-colored glasses, you can know with a better accuracy what your costs are going to be.
Yeah, for sure. So when we're digging into the numbers, what I like to do when I'm underwriting these deals, I've got, and I've created this fairly recently now, is I've got like a quick deal analyzer and I've got my regular deal analyzer. My quick deal analyzer is just meant to throw in some of the basic numbers and see if the deal actually works. So I throw in some very basic numbers, takes less than 10 minutes, probably, maybe depends on how much information I have, but it takes 10 minutes to maybe a half an hour. You throw in some of these numbers and it'll tell you, where you can buy the property at. And if you're fairly close, then let's dig in. But let's just say my quick analyzer says I can buy the property at 5 million and they're trying to sell it for 8 million. I'm probably just going to go, okay, this deal's not for me. But if I say, hey, 5 million works and they're saying 6 or 5.5, then yeah, let's dig in. So that, first things first, I want to have something that allows me to look at these numbers fairly quickly. I want to figure out how to look at them quickly because I want to look at a lot of deals and strike them off my plate. Then as I dig in, that's where I really got to make sure I understand what's going on in the market. I understand some of the expenses, the income, and stuff like that. So how do we figure that out, Matt? Where do we go?
Well, there's various websites that you can go to, like City Data, I think has a lot of good information.
Hey, real quick, I just want to let you know about the multifamily challenge that we got going on. It's a 5-day multifamily challenge on how to get an offer in quickly, right? So we're going to teach you in 5 days, 5 1-hour sessions. We're going to go through the steps and the process to get there. So go to mfichallenge.com, mfichallenge.com. You can sign up. It's free if you want the VIP. There's a bunch of things that we'll give away too. You do have to pay for that, but hey, it's going to be well worth it. Again, you can get in for free. We're going to teach you how to get that offer across the table, get the LOI in, all the steps. So Ellis Hammond and Ellis was episode 316. Check out his episode. And we're going to be doing this next week. So sign up now at mfichallenge.com, and get in there. We're doing it next week, and it's going to be awesome. So hope to see you there.
Well, one great resource is talking with your property management company, because they've got eyes on the ground. They've lived it. They've experienced it. They know what those expenses can be.
Right. And it's real time, right? So, I mean, they've got properties, unless your property management company isn't very well versed in the area, which in that case, you should probably get a new property management company, but they've got properties that are nearby. They've got likely experience with who's doing what in the market. So, we can look at their property, their portfolio, especially when we're looking at expenses. This is huge, right? If I'm buying a 1970s building and, it's in this submarket, and I talk to the property manager and we get an idea that, hey, look, we manage a bunch of 1970s product in this area, and this is where your expenses will be. Like, they know exactly, like you'll be spending $6,200 per unit on expenses, or $4,500 per unit on expenses. If your underwriting comes in and they said it was $4,500 per unit on expenses, and your underwriting comes in at $3,200, you got some work to do, right? But if your underwriting comes in at $4,500 or $4,600 or $4,800, you're probably pretty accurate, right? So we can ask the property management. Expenses are huge. Income too. I mean, look, they can pull reports. That they are very good at getting rent comps. They're good at secret shopping. Now, this is typically as we're digging deeper into the property. It's not, very first step. But we can get an understanding of where we should be at. So I think that's super valuable. Just boots on the ground. Who's our boots on the ground? That's our property management company. And as you said, like there's other good resources, city data. You got CoStar reports that typically your property manager, your broker, or your lender can pull. So there's a lot of other good information out there that you can get. Some of the keys I like to really make sure is we got a good reserve account. We talked about having an opening reserve account, but then we need a continual reserve account where we're feeding it. So I'm typically about $300 per unit per year. If I've got a new property, I might be a little bit less. I might be into that $250 to $275 range, but typically I'm like $300 per unit per year. One of the other things I see is a lot of people thinking that they can get done the repairs and maintenance for a lot less. I really think that's a big mistake. You've got to repair and maintain your property. If you don't, you're going to be a slumlord. So make sure you have plenty of expense in the repairs and maintenance. I'm typically underwriting right around that $400 to maybe up to $600 per unit per year, depending on what's going on in my property.
I think in general, just plan for higher expenses, more problems coming across. So like when things go better than expected, then there's unexpected profits that you can bring to your investors, and that they're going to be happy about that.
Absolutely. Absolutely. And the other thing too, when we're looking at our underwriting, is we're getting close, run it by your property management company, like we've already kind of talked about. And the other great person or team member is going to be your lender. Run it by your lender. They're looking at these deals all day long. They can tell you if this deal scratches or not. It's easy for them to look at a deal quickly. They're looking at numbers all day. They know what their money sources want. And so they'll be able to tell you yes or no. They'll be able to tell you, hey, you know what, tighten this up, or, hey, I don't think you can get there. Here's what we're going to have to do. Or we're only going to be able to give you 60% loan to VAT or loan to cost if you buy it at this price. So those are great people to run these deals by.
Yep, absolutely. And they want you to succeed. And so they're going to give you some honest feedback.
I think the last thing you need to really know and understand is you need to know and understand what your debt sources are. So again, talking with that mortgage broker is really important. Knowing and understanding that you're going to have 1.25 debt service coverage ratio on today's numbers, unless you're doing a bridge loan, but that 1.25, and knowing that, look, the lender's going to add more expenses in if needed. Even if the seller is self-managing and they got really low expenses, they're going to add expenses back in to make it so the numbers are real. And then, know and understand what kind of debt you're going to get, because that's a big part of your underwriting. Look, if I'm going to get 3.2% interest rate versus 4.2% interest rate, that makes a world of difference whether I can buy that property for a specific price or not. So knowing what your debt is extremely important. Getting that down.
Yeah, exactly.
I mean, there's all kinds of other things, Matt, that we can talk about. Like I said, it's hard to really dive deep into underwriting. I would suggest anybody who isn't really familiar with underwriting, take an underwriting course. As you said, there's people that are selling spreadsheets out there. I don't sell mine. I may at one point in time, but I don't right now. I don't sell mine. So, just really start to think about taking a course and then, diving into underwriting. I think practice is what it's going to take.
Exactly. I mean, even if you just get one for free or you buy one from somebody, using it is the biggest hurdle, understanding the tweaks and ways to adjust it. And that's why a class or a coaching or a mastermind or something like that to really walk you through to help you get experience. And then just practicing it just a ton of times is going to make you more and more proficient.
A couple more things, Matt, that now I'm thinking about it. Like, look, one thing I see a lot of people do that I don't necessarily like to do is I see people adding a bunch of value to year one. So they're saying maybe my year one income or my current income's at $1 million. They're saying, hey, we're going to raise these rents. And all of a sudden you look and their year one income is at $1.3 million. It just doesn't happen. So value, your NOI won't really increase in year one by much, if at all, and it might decrease. So, make sure. I always tell people to make sure year zero, which is current, versus the end of year one is about the same within a few percentage points. We don't want to see a big increase. It's just not going to happen. Yeah. The other thing is, I see is people talking about cap rates. I love the underwriters or the people that are buying properties and they're buying it at a 4 cap. And so they say, hey, in 5 years, we're going to sell it at a 4.5 cap. But what they failed to tell you is that the market currently, it's not a 4 cap. They're just overpaying for the property. The market currently is at a 5.25 cap. And so they're overpaying for it, but then they're saying they're going to go sell it for a 4.5 cap. And you're like, wait a second, you're upside down already. That happens quite a bit. So really look at the cap rates, what's going on in the market. And then you should be, your reversion cap rate, your cap rate when you sell should be higher than that. And then the last thing is really decide on what your exact strategy is prior to starting to underwrite. When are you going to sell it? What type of value add are you going to do on it? And the other thing too is to think about especially if you've got a deal that's kind of attractive. Look at the underwriting a couple different ways. I underwrote a deal, a large portfolio deal that I was really excited for, and I chased all the way to the end. And I underwrote it for a fairly good size renovation to happen. And then I also underwrote it for a light renovation to happen. And I ended up finding out that if I did the lighter renovation, my profit would actually be greater, and therefore I could pay more for the property. So we can come up with a couple different strategies on some of these deals and go, oh, that actually works better. So sometimes you'll surprise yourself as you're looking at properties.
That's great advice. Yeah. And one thing I was going to say about NOI, sometimes the best way to control NOI is just by decreasing expenses instead of trying to increase income in year one.
Yep. Yep. Are you getting chased by the cops? You got to go.
No, I don't. They're after someone else, not me today.
Perfect. All right, man. Well, again, I mean, we could dive in, we could get a little deeper, but I think it's a lot more challenging just being on podcasts. So those are just some of the key things to be thinking about when we're looking at underwriting. There's a lot of other, things I think really get to know, kind of the terms and what market expectations are, understanding where these properties are selling at, understanding where other investors are buying things at, what your investor return expectations are, what's comfortable for them for a cash on cash, what's comfortable for them for internal rate of return. What are they looking for? I think that's really important to think about. And then also, like, for your own strategies, what type of value add do you like to do? Do you like to do big, heavy value add? Do you need a certain increase in rent? For me, I got to increase rent typically at least $100 per unit for a deal to even begin to pencil out. So, if you're looking at a deal and the broker OM says you can increase rent by $75 a month, well, that probably is not the deal for you to even dig into. So
good.
Cool, Matt. Well, that's all I got. Do you have anything else you want to mention?
No, that's it for today.
Okay. Awesome, Matt. Well, hey, you have a fantastic rest of the day. Make every day a Saturday.
Thanks. You too.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.